And we're going to cover an awful lot in the next 50 minutes or so. So everybody hang tight, and I'd be happy for Alpha to share these slides with anybody who would like them. Or I can send them to you afterwards if you'd like as well. Hopefully we'll have a few minutes for Q&A at the end, but we really are covering a ton of content in a very short period of time. So bear with me as we race through it. We're going to take a look at what's going on in the economy, because that's the underpinnings of everything that happens in real estate. We're going to take a look at the housing market, what we're seeing in real estate investing activity. Just a quick snapshot of what we're seeing in rental trends. We'll take a look at foreclosure activity, which there's not a lot of, spoiler alert there. And then I'll just share with you some closing thoughts as we go forward. So jumping right into the economy. The economy is actually chugging along fairly well right now. We saw that the second quarter's gross domestic product numbers, the GDP numbers, which is the basic metric that economists use to gauge how strong or how weak the economy is. Those numbers were downgraded a little bit from the preliminary estimates in the second quarter. They were originally at 2.4%. Now they're at 2.1%. But the bottom line is the economy continues to grow, and it grows despite the best efforts of the Federal Reserve to slow things down, and it's growing at a rate that's higher than what most economists had forecast for this time of the year. So all of those headlines you've been reading about the possibility of an upcoming recession are kind of on hold right now. Jury is out. About half the economists I speak to still believe we'll have a recession sometime next year, but most of them believe if we do, it'll be fairly mild and fairly short. Because again, most of the economy is doing very well. I should point out as we go into this that the GDP is very dependent on consumer spending. About 2/3 of this GDP number is made up of consumer spending. So as we see GDP growth, it usually suggests that the consumer is fairly healthy. Consumer finances are fairly strong, and that's really what we're seeing here. But there are some red flags that we're going to take a look at as we go forward. I mentioned that other parts of the economy, that most of the economy actually is doing very well right now. The jobs market is probably the best example of that. Unemployment is inching up slightly. We're somewhere between 3.7, 3.8% right now. That's up from lows of 3.5% a year or so ago. But the numbers are historically low. If you look back at unemployment rates over the years, economists look at a 5% rate of unemployment as being pretty much full employment. And the fact of the matter is that we've been below that for quite some time. One of the reasons that the unemployment rate is going up slightly is that more people are coming back to the jobs market. There's another measure that's called the labor force participation rate, and that's just the percentage of adult Americans who are either working or looking for work. And that number dropped lower than normal as we entered and exited the worst part of the pandemic, particularly for workers 55 years or older or 25 years or younger. And those numbers haven't still recovered to pre-pandemic levels, but they're coming up a little bit, particularly on the younger end of the spectrum. And what that means is as more people enter the workforce looking for work, that's going to make unemployment go up just a little bit, but it's certainly not a sign for concern. It's just a little bit higher than what we've seen recently. Wage growth is continuing. It's slowing down a little bit, but it's still outpacing inflation. So whether you're looking at salary, wages, and growth year over year, which is just about 5% year over year, or average hourly wages, which are over $29 an hour now across the country. In both cases, those numbers are going up. And this is the first time in many years that I've been able to say that wage growth is actually going up faster than home prices, actually going up faster than inflation. So the numbers, I'm sure it still feels painful for a lot of households as they see inflation numbers go up, as they see food prices and gasoline prices higher than they were a year ago. But generally speaking, we're seeing wages go in the right direction. There are some early warning signals that we're seeing in terms of what's happening with consumers. And even those last two numbers that I gave you, if you look at them alone, unemployment numbers or wage growth numbers, you can see that both of them by themselves look okay, but the fact that they're both sort of trending in the wrong direction a little bit is maybe an early warning. This is another one. Consumer confidence is still relatively low, and it continues to decline. And what we're seeing is a disconnect between consumer confidence and consumer spending. Historically speaking, consumer confidence and consumer spending went hand in hand. The more confident the consumer was, the more willing they were to spend money. This is particularly true on big ticket items like cars and homes. And coming out of the pandemic, we saw that relationship continue. When the pandemic was declared, consumer confidence dropped pretty significantly. The government shutdown occurred, consumer spending dropped. As we sort of exited the pandemic, we saw consumer confidence start to go up along with consumer spending. But then we had subsequent waves of COVID. We had the war in Ukraine. We've had inflation. We've had a number of other factors that have contributed to consumer confidence getting down to really all-time lows. And despite that, we saw consumer spending continue to go up. This is troubling from two perspectives. One, for a while, consumer spending was going up because of pent-up demand. We had supply chain disruptions that made it difficult for people to buy things that they wanted. And they had a lot of money in the bank because of stimulus checks and enhanced unemployment benefits. And so for a while, it was just pent-up demand. Now we're a little bit concerned about the breadth of this gap between consumer confidence and consumer spending. And the likelihood is that if consumer confidence continues to go down at some point, it will drag consumer spending along with it. And in fact, in the last 2 months, we've seen consumer spending overall flatten and start to come down a little bit. The worry here is that we could actually see confidence go down enough to drag consumer spending with it, and we could literally worry ourselves into a recession. One of the other red flags that we look at is consumer credit card use. And last quarter, for the first time ever, consumer credit card use surpassed $1 trillion. Just the amount of consumer credit card use is a little bit of a red flag, but the concern here is a little bit more than that. The concern here is that households at the median income level or lower may be tapping into their credit cards in order to make ends meet in this high inflationary environment, this high cost of living environment. Inflation numbers are looking better on paper, but I have my own index, which I call the Costco price index. It's my own CPI. And a year ago, I was buying salmon at Costco for $9.99 a pound. That same salmon today costs $12.99 a pound. That's a 30% year-over-year increase. And I'm blessed in that I can look at that as an annoyance and just pay a little bit more for my salmon. But I am concerned that a lot of households don't have that luxury and are tapping their credit cards to buy food, to buy gas, maybe to pay their rent or pay their mortgage. So it's a trend we need to watch. Similarly, another red flag is that personal savings rates have continued to decline. So we went back in 2020 when the stimulus checks went out and there was nothing available to buy. We saw savings rates go to all-time highs. We saw the same thing in 2021 when there was a second stimulus package that was sent out. But since then, we've seen savings rates continue to decline. And in fact, some recent research indicates that the average household has more in credit card debt than they have in savings. That's not a good ratio. And left unchecked, and if it continues to go in that direction, we don't see a good ending for that movie. So again, these are consumer red flags that we're watching. None of them individually is enough to cause an alarm, but collectively, something to keep an eye on. And it's starting to show in delinquency rates. We'll get into mortgage delinquencies in a little bit, and those are still very, very low. But if you look at other types of consumer loans, whether it's just a consumer loan, it's credit cards, it's auto loans, all of those delinquency rates are up to the highest number they've been at in a few years. The auto loans, there were a lot of subprime loans issued to automotive buyers over the last couple of years in an effort to stimulate sales. credit cards have not been as relaxed in terms of qualifications. Certainly consumer loans have not been, but we are seeing delinquency rates go up. The good news, if there's good news in a chart like this, is that most of the delinquencies are early stage. So they're 30-day delinquencies. We're not seeing summary increases in 60 days or 90 days or higher levels of delinquency. So it seems like, at least for the time being, consumers are missing a monthly payment and then catching back up. But this is not a positive trend to look at. And again, it's something for us to keep an eye on as we wonder whether or not a recession is in store. A lot of the churn we're seeing in the marketplace is due to what's going on with the Federal Reserve. I mentioned credit card use is at an all-time high. We're seeing credit card delinquencies go up. We've also seen interest rates on credit cards approach all-time highs. Not at all unusual for a credit card holder to see their interest rates going up to 27, 28% today, even for people with good credit. And that's because the Fed funds rate has gone up as high as it has. So I'm showing you this chart to give you an idea about two things here. The dotted line that you're looking at is the rate of inflation. And you see that coming out of the pandemic, the rate of inflation just skyrocketed. Initially, the government and the Federal Reserve were quick to blame supply chain disruptions and the war in Ukraine for the rise in inflation. But the fact of the matter is that government policies and fiscal policies had a lot to do with inflation. We overstimulated the economy to prevent a severe recession coming out of the pandemic. And really overshot the mark. One of the economists that I follow closely had a great way of putting it. He said, we tried to stuff $15 trillion into a $3 trillion hole, and we increased the money supply significantly, and we've seen the impact of that in inflation. The Federal Reserve also admitted that it kind of whiffed on this inflation cycle. They expected inflation really to be transitory. They didn't expect it to get as high as it got, and they didn't expect it to stick around for as long as it did. And because of that, they've had to act in a very aggressive manner and in a manner that's simply unprecedented. So inflation got to the highest point we've seen since the 1980s, and the Federal Reserve raised the Fed funds rate in an unprecedentedly quick level. In ways we really haven't seen before. Even in the 80s, they didn't raise rates quite this quickly. And if you look at the shaded area, that kind of shows you how the Fed has acted. That represents an increase in the Fed funds rate. And you can see we're up over 5% now, about 5.5% on the Fed funds rate. But if you go back to the last time they raised the rate to try and fight inflation, you can see a more typical pattern. They raised it a little bit, waited to see the impact, raised it a little bit more, and so forth and so on, until they felt like inflation was under control, and then they dropped the rate. In this case, they just kind of went for the ceiling in terms of raising the rates, and that's had a pretty dramatic impact on the financial markets. One of the things I have to point out to you is, if you look at that dotted line, you can see that over the last couple of months, we've seen inflation actually tick up a little bit on a month-over-month and year-over-year basis. So again, overall, the trend lines are moving in the right direction, but that little blip up in inflation is something to keep our eyes on. The belief is that it's mostly energy costs related to gasoline, but it's something that time will tell. The Fed activity and their posture, where they've talked about keeping rates higher for longer, has caused the bonds market to react. It's certainly volatility in energy prices has caused some of this too, but we've seen the rates on the 10-year Treasury yields go up to the highest number they've been at in well over a decade. And this is relevant to us in the real estate market, because the rates on a 30-year fixed rate mortgage are loosely tied to what we see in the 10-year U.S. Treasury yields. And unsurprisingly, we've seen both of those go up. And a little bit surprisingly, the gap between that 10-year Treasury yield and the 30-year mortgage rate is the highest it's been in many, many years. So normally, if you want to guess what the 30-year mortgage rate is going to be, you look at the yield on a 10-year U.S. Treasury, and you add somewhere between 1.5 and 2 points. So if the Treasury yield is 5%, you would see a mortgage rate of somewhere between excuse me, 6.5% and 7%. When this chart was put together, the yield was around 4%, a little over 4%. And so we should have seen a mortgage rate of 5.5% to 6%, and instead we were seeing something closer to 7%. So there's a bigger gap than usual between treasury yields and mortgage rates. A lot of that is caused by risk and volatility in the market that folks are pricing into these mortgage rates because they're not really sure what the Fed's going to do next. And the other concern is that most everybody believes that mortgage rates will come down over the next couple of years. And so the market is building in a little bit of more profitability early to kind of cushion what might happen if we have a lot of prepayments as mortgage rates come down and people refinance out of these higher rate mortgages. So a really, really unusual time. And because of that, we're seeing unusually high rates of mortgages. I like this chart from the St. Louis Federal Reserve because it does two things. One is it shows you that rates, historically speaking, if you go back over the last 50 or 60 years, are still relatively low. When I mention that to groups, I hear from a lot of young people, it's like, oh, okay, boomer, we get it. But last time rates were this high and you bought a house for $75,000 or $100,000, and the median price today is about $400,000. It's a fair point, and so the combination of historically high prices and these rates doubling year over year has really made affordability an issue. The other thing is it really does show the dramatic increase in mortgage rates over the last couple of years. According to Freddie Mac, last year was the first year in history when mortgage rates doubled in a single calendar year. And as you'll recall, they didn't only double in a calendar year, but they doubled literally in the space of a few months. And that made affordability just about impossible for a lot of prospective home buyers. So the raise in mortgage rates has had a dramatic impact on the housing market. This is mortgage rates as of September 27th from Mortgage News Daily. It's not what we're seeing this week, but the numbers are close enough. You saw mortgage rates that day at 7.65% for a 30-year fixed rate mortgage. A year prior, it had been, somewhere in the threes. So just crazy, crazy rate of increase. And unsurprisingly, we've seen mortgage applications dip. So these are applications for mortgage loans, not refis. And these are people who would have been buying a house. And you can see that those applications are down year over year and well off 40% from their peak. So unsurprisingly, as mortgage rates have gone up, applications for mortgages have gone down. If you look at this data from the Mortgage Bankers Association, you can see just how far things have fallen. So from $1.4 trillion dollars worth of mortgages issued in 2021, down below 600 billion the following year. And you can see a drop from there down to an estimated 4.4 this year, or 440 this year, starting to recover next year, but not really recovering in a material way, even into 2025. So slightly better in 2025 based on the forecast than we were in 2022. But a big part of this is that refi volume is expected to be low for the next few years until mortgage rates drop sufficiently, or we've had enough people buying at higher rates that rate-based refinance will make sense to them. But again, down from very, very high levels of mortgages to much lower. And not surprisingly, the other future-looking metric that I follow besides the purchase loan index is pending home sales. And this is coming from the National Association of Realtors and analyzed by Altos Research. And we're about 12% below where we were a year ago. And again, when this snapshot was taken by Altos, there were about 59,000 new pending sales that week, which was 14% lower than it was the same week a year ago. So whether you're looking at total sales pending or new pending sales, both are down on a year-over-year basis. And again, not really a huge shock considering the affordability challenges a lot of prospective buyers are looking at. Also, no shock then that if loan applications are down and pending sales are down, existing home sales are also down. And if you look at the August numbers, they were down only marginally from July, but they were down, and it's continuing a really unusual trend. If you go back to the beginning of 2022, and those are the blue bars you're looking at here, that year was a very, very unusual year for existing home sales, in that January had the highest number of existing home sales for the year, and that sales declined every month after that for the rest of the year. That means we basically wiped out the spring and summer selling season, which is usually when we see home sales go up before they go back down again toward the end of the year. We're looking at a very similar pattern in 2023 with one exception, which is that January home sales actually were the lowest month we've seen so far this year. They continued that decline from December. They perked up a little bit in February as we saw a temporary reduction in mortgage rates, but have been down then again every month consecutively since then. And August represented the 24th consecutive month where we've had a decline in the number of sales on a year-over-year basis. So when we started this year out, my forecast was that we'd see somewhere between 4.3 and 4.4 million existing homes sold. Reality is right now we're trending in at right around 4 million existing homes, and could wind up slightly below that by the end of the year. That's due in large part to affordability. It would be the lowest number we've seen since 2009, when we were in the midst of the Great Recession. And it's just an indicator of the weakness in the housing market today. The other reason we're seeing these numbers as low as they are is because inventory is down. And whether you're looking at monthly numbers, months of supply is down below 3 months supply. In a normal, healthy housing market, that's about a 6-month supply. And again, we're not recovering. And if you look at the year-over-year change, which is the blue line there, it looks like it's ticking up, but that just means it's falling more slowly. So we're down year over year about 14%, down below a 3-month supply. There's just not enough out there to handle the demand. And by the way, that's one of the reasons that prices have not plummeted and are unlikely to plummet. One of the fundamental differences between this cycle and last cycle is if you go back to 2005, 2006, you can see that inventory available for sale peaked at about a 13-month supply right before the market crashed. So there was twice as much inventory as the market's used to absorbing. In this case, there's half as much, and that is, among other things, protecting prices. Some other data from Altos Research, who tracks this inventory weekly. So the data we just looked at was from the NAR. They track it monthly. But if you look at inventory now, it's growing at a pace that's unusual for this time of year, but it's a little bit of a head fake. We're still down significantly, probably 40 or 50% from where we were in 2019, which was probably the last normal year we've seen in terms of inventory available for sale. But we're growing late in the year, higher at a time of year when we'd normally be seeing inventory go down, but it's not because we're seeing a lot of new listings. What we're seeing is that properties listed for sale are simply taking a little longer to sell. And because of that, it looks like the inventory levels are going up. But there's very, very little in the way of new listings. They're down year over year. And the reason for that is a phenomenon that economists refer to as rate lock. And that means you're a homeowner with a very low mortgage rate, and you're not inclined to sell your property and take on a higher rate mortgage. This is some data from Freddie Mac from their national mortgage database. According to Freddie Mac, almost 93% of homeowners have an interest rate at or below 6%. But the really amazing one is almost 2/3, a little over 2/3 of homeowners with a mortgage have a rate at or below 4%. That's the green area on the chart on the right-hand side of this slide. And if you think about that, the math just doesn't work for a homeowner with an interest rate that low to sell that house and take on a higher rate loan. Think about it. If you're sitting on a 3.5% mortgage and you sell your house and buy a new house for exactly the same price as the one you just sold, you basically just doubled your monthly mortgage payment. And most people simply can't afford that kind of increase in a monthly mortgage payment. So what that means is these folks are locked into their homes and they're going to be sitting there for quite some time. This isn't a matter of choice. In a lot of cases, it's a matter of economic necessity. The inflection point that most of the economists that I talk to believe will trigger more homes coming up available for sale is once we see mortgage rates get back down below 5.5%. The alternative to that is we wind up sitting in kind of a limbo period for the next 2 to 3 years, with home sales continuing to be weak, prices going up but only marginally, and it'll take that long for this to become the new normal. These higher prices and higher mortgage rates, and at that point we'll start to see the market loosen up. But those are your two alternatives. We either see mortgage rates come down significantly, or we're kind of in this Groundhog Day sort of phenomenon for the next couple of years where the housing market is just completely unexciting. Because there's so little for sale and because there's a demographically driven demand, and I haven't talked about that much, but keep in mind right now we have the largest group of young adults between the ages of 25 and 34 in the history of the country. So we have the millennials, millions of millennials coming of age to form households and buy houses. And right behind them, we have Gen Z starting to get to that age bracket as well. And because we have that pent-up demand and so little supply, we're starting to see year-over-year prices go up. And this is the Case-Shiller index. And whichever of their indices you're looking at, the top 10 markets, top 20 markets, or nationally, they all kind of bottomed out in May and started to go back up again in June. NAR is showing the same sort of indication. We saw with NAR data that prices bottomed out, turned the corner in June, and have gone up in July and August each month. In their analysis, prices are now up about 3% year over year. If you look at this chart from the FHFA, and the FHFA is the government entity that controls Fannie Mae and Freddie Mac, their numbers are up 4.6% year over year. So existing home prices, even though they've been trending down, are now positive in every region of the country on a year-over-year basis. Now, again, these are Fannie Mae and Freddie Mac backed loans, so these are your vanilla conventional mortgages, 30-year fixed rate loans primarily. But up until this last month, the Pacific region and the Mountain region were both showing year-over-year declines in prices, and kind of coming back to normal levels after a couple of years of extraordinary price growth. But as you can see, these existing home prices, again, because very few people are putting their properties on the market, are showing year-over-year increases. By the way, one of the reasons I like using this data and the Case-Shiller data to indicate price changes is because it typically is showing same property sales, and so the importance of that is if you look at the NAR data, which is good in its own right, it's showing you median prices, and that median price can be influenced significantly by the product mix. There's very, very little available for sale at the entry level right now, which means most of what's selling are higher priced properties, which takes that median price point up a little bit, maybe artificially. And again, the data we're seeing here is pretty much same property sales. New home sales, contrary to what we saw in the existing home markets, are actually doing a little bit better. Now, they came down in August as mortgage rates went up, and if you look at builder perspectives, they're anticipating that things will continue to go down a little bit because interest rates have just gotten too high for people to be able to afford these properties. But new home builders are making properties available for sale. They're offering incentives for people to purchase these properties, and because of that, they're doing a little bit better than forecast. Again, beginning of the year, I was looking at about a 600,000 number. For full year new home sales. Right now, it looks closer to 675, and we'd be selling more new homes if they were more ready to go. Now, contrary again to what we're seeing in the existing home market, new home prices, median price for a new home this year is down about 16% from peak last year. Now, this does not mean that builders are discounting existing inventory. What it really means for the most part, is they're building smaller homes or they're building less expensive homes. So they are dealing, and these lower prices are attracting buyers who simply can't find existing homes to purchase. Their inventory is better than what we're seeing on the existing home front, but still not quite back to normal. The blue line you're looking at here are the months of supply of properties that are under construction. The red line is new homes where construction has been completed, and the gray line are months of supply for properties not yet started. Those are basically permits. The gray line is a very positive here. It shows us that builders are optimistic about the future, that they are buying lots, they are getting building permits, they're getting ready to build. The blue line coming down, it normally might be a concern, but right now we're coming off a really weird circumstance where we had the highest number of homes ever under construction and the lowest number ever that were completed. And it was basically due to supply chain disruption and labor shortages. So it was simply taking builders longer to complete the construction of homes. And now what we're seeing is they're working through that backlog. They're selling these properties once they're completed, but they're actually selling many of these properties before they're completed. And that's why that red line hasn't come up more than it has. But we're seeing new home sales, again, much more strongly than we're seeing existing home sales, relatively speaking. In a normal market, new home sales account for maybe 10% of sales, 10 to 15%. In today's market, they're more like 25%. So it's a pretty significant shift in our normal patterns. There's another headwind that's starting to rear its head, I guess, to mix metaphors, in the housing market. It's insurance costs. And we're seeing that buyers are very concerned, or somewhat concerned at least, about the rising cost of insurance nationally, but mostly in states like Texas and California and Florida. And you know, as a California resident, I can relate to that. I got a premium notice from my insurer this year that would have doubled my premiums. I was able to work through a broker and find somebody to provide insurance for a little more than I paid last year, but not doubling. But in a lot of parts of California and Florida in particular, it's hard to get insurance at all because of flood risk and fire risk. And so buyers are now concerned about the availability and cost of homeowners insurance. And it's actually starting to have an impact on sales in those two states. You might wonder about Texas. Texas is having an unusually high number of severe hailstorms. According to a company called Verisk, 18 of the top 20 markets across the country that experienced an increase in severe hail events this year were in the state of Texas. And hailstorms cause, as you can imagine, a significant amount of damage, particularly to roofs in the residential market. But these insurance costs and the availability or lack of availability of insurance starting to have a material effect on home sales. So yet another issue for the housing market to have to deal with. If you're looking at the residential market and trying to figure out who's buying what, according to this report from CoreLogic going through June of this year, investors accounted for about a little over a quarter of all home purchases. That's not an historically high level, but it's toward the high end. And it's partly because investors have remained active, and it's partly because the consumer share has dropped a bit because consumers, again, are being priced out of the market. This is a significant share of market. If you're an investor yourself, you should know that a lot of the competition you're facing today is from fellow investors, but there are a lot of opportunities out there. If you're somebody who works with investors or who should be working with investors as a lender, as a real estate agent, this is a pretty significant share of the market. If you're not playing in that part, you're ignoring a lot of opportunity. I also believe, and this is not a knock on CoreLogic data, but I also believe that this number understates the actual amount of investor activity we're seeing. The way CoreLogic tabulates its data and the way some of the other data companies do as well is they will count a sale as an investor purchase if the buying entity has a corporate type of name, LLC, an LP, Corp, something like that. but it doesn't count as investor purchases. Investors that don't use that kind of entity when they're buying a property. And we all know that there are a lot of individual investors out there who don't have a corporate entity that they use when they're making these purchases. And they account for a huge portion of all buying activity. If you look at who's buying these properties, about 46% of investor purchases are by the smallest investor. These are people that'll buy usually between 1 and 10 properties a year. Another 36% or so are mid-size investors. And the largest of the large investors collectively are probably somewhere in the 10% range. And in fact, if you look at every research report done over the last 20 years or so, and you look at who's buying and who owns single-family rental properties, about 90% of those owners are people that own fewer than 10 properties. The largest of the large institutional investors collectively altogether own somewhere in the neighborhood of 3%. So all the headlines you're reading about Wall Street gobbling up Main Street are hyperbole. The investor market continues to account for a significant share of sales out there, but the majority of those purchases are made by small and mid-sized investors. And in fact, anecdotally, I can tell you that a lot of the largest of the large investors right now have backed out of the market. So if you're a small or mid-sized investor, you're probably in a position right now where you have less competition from the big institutions and less competition from traditional homeowners for different reasons. I think the investors are kind of waiting for a little bit of a dip in prices, a little bit of a dip in activity so they can come into the market and optimize their purchase. And in some cases have shifted some of their funding into build to rent activities. So they're building these rental properties now from the ground up, working with the builders. And candidly, if I were an institutional investor, had a lot of money to invest in this space, I would probably be doing the same thing. And I kind of wonder why they weren't doing it earlier. More price certainty about what it's going to cost you for these units, better quality control, a more homogeneous approach to the types of properties you're going to have to maintain going forward, and a guarantee that your properties are going to be proximate to each other, a concentration in geography, rather than competing on a one-off basis and having one of your properties on one side of Atlanta and one of your properties on the other. Again, still a fair amount of investor activity. And a lot of that activity has shifted from fix and flip into the single-family rental market. So you have people buying properties and renting them out. So according to Adam's most recent data, the Q2 data on fix and flip, we saw the number of flips go up a little bit quarter over quarter, significantly down on a year over year basis, and account for a slightly lower percentage, about 7% of all home sales, than what we saw the prior quarter in the prior year. It's been a rough market for flippers, but the fact that there were a few more flips in the quarter probably corresponds to home prices starting to go up a little bit. If you're a flipper, you know it's really difficult to make a profit in a market where prices are going down. So that return of prices going up a little bit, combined with low inventory, is probably working in their favor. The downside, the reason we're seeing fewer flips, is because that buyer who might have been looking at your $300,000, $400,000, $500,000 flip can't afford it anymore. And the buyers who are looking at more expensive properties may not necessarily want the kind of property you're getting ready to sell. So it's been a tougher market for flippers over the last year. We are seeing, I recently did some market research surveying investors for RCN Capital, and the fix and flip investors are much more optimistic about conditions improving than the rental property investors are over the next year. So it'll be interesting to see how that all plays out. Speaking of rentals, and this is data from RealPage, and it tracks multifamily rates more than single family, but we can use that kind of as a proxy. And you can see that what's been going on is that rental asking prices are still up on a year-over-year basis, but only by the slimmest margin. So they've been trending down. They hit historically high levels. Asking rates about a year ago were at 15% higher number than they'd been the previous year. Now that was partly because the previous year was very low, but still, this is a market where, on average, you see asking rents go up between 1% and 5%, and they were at 15% when they peaked, which is just crazy. Now they're back down below 1%. That's partly because renter activity has slowed down a little bit. It's partly because there's a record number of new apartment units coming to market this year. Some estimates have suggested that we could see as many as 1 million new apartment units coming online this year. And so that combination of new supply and a little bit less activity among new renters is keeping those prices from going up. Interestingly, at least interesting to me, I hope it's interesting to you as well, what we're seeing in terms of rental declines tracks pretty closely with where we're seeing home prices go down too. Now, I mentioned that nationally, home prices are up year over year, but that doesn't mean they're up in every market. Really important for you to keep in mind as an investor, whether you're renting properties or buying properties to flip, that local market conditions are often very different than what you're seeing in national headlines. If you're in coastal California, if you're in the Pacific Northwest, if you're in Austin or Phoenix or Boise, you've probably seen property values, home prices come down pretty significantly year over year. On the other hand, if you're in the Midwest, if you're in the Southeast, very likely you're seeing prices continue to go up. So if you look at the cuts in asking rent, that's the chart on the right, you see some of the same markets that we saw, Boise, Austin, Phoenix, Las Vegas, some of the same markets toward the bottom there, Salt Lake City, San Francisco, Oakland, where we saw home prices go up precipitously and then come down, are the same markets that we're seeing rents come down a bit. On the other hand, secondary, tertiary markets, markets in the Midwest like Madison and Champaign, Omaha, those are markets where we're seeing rent prices go up the highest. Not sure what's going on in Odessa and Midland, Texas, but I'm guessing it's probably supply-demand issue there. It's usually the case when you see rents go up that much. But again, something to keep in mind as you're looking at investment opportunities is the very, very strong regionality of prices, whether you're looking at prices of homes for sale or properties for rent. And you can see that vacancy rates have stabilized. Now, this orange thing coming down is actually not good if you're a landlord. That's showing occupancy rates. Now, the 20-year average is about 94.5% occupancy rates. So that means that you have an average of about 4.5 or 5.5% vacancy rates. And we're right back down to that average now. When we saw prices peak, when we saw the amount of inventory available for rent down at its lowest, we had occupancy rates of almost 98% across the country. And again, that supply-demand imbalance is what kept those rates as high as they were. But we're not seeing vacancy worsen. We're seeing it get back to normal levels. There are some markets that, because of the amount of inventory coming online this year, may wind up being slightly oversupplied, and there might be some where there's still not enough. So it really is going to depend on you being an expert in your local market to figure out what's happening there. Finally, just to kind of run through delinquencies and foreclosures, I know a lot of investors, a lot of real estate professionals tend to follow this part of the market closely. So I thought I'd share it with you. A lot of people were under the, as it turns out, mistaken impression that borrowers who went into forbearance would ultimately wind up in foreclosure. Just the opposite has happened. And if you're looking at active forbearance plans, we're down to about 160,000 borrowers in forbearance. At the peak, there were about 4.5 million people in forbearance. All told, from the beginning of the program till today, there were about 8.5 million borrowers who took advantage of being in the program. Again, we're down to the last 160,000 as of today. And a lot of those are in not because of the COVID forbearance program, but because lenders have allowed them to enter this program due to natural disasters, due to extreme weather events, whether it was hurricanes in Florida or wildfires in other parts of the country. And this program, the COVID part of the program, will expire at the end of this year. And so those remaining borrowers will be exiting shortly. What's been really fascinating is just how successful this program has been. For my money, in the 25-ish years I've been in the industry, probably the single best example of the government and the industry, the mortgage industry, working together to achieve a positive outcome. But you remember that I mentioned that there were 8.5 million people in forbearance. 86% of the people who have exited the program have either paid off their loans or were current. Just a remarkable percentage of people performing or paying off their loans. Now, again, some of those loans that were paid off due to selling the property or refinancing. But bottom line is just a remarkable positive outcome. About 1%, depends on whose numbers, excuse me, you're looking at. Pardon me. A little bit less than 1% here, even lower number if you're looking at mortgage bankers' data. But they've exited and experienced a distressed liquidation. So that's a foreclosure, a deed in lieu, a short sale, something along those lines. But think about that, 8.5 million people and less than 1% defaulted on their loans. About 5% are still in the forbearance program, either their original forbearance or an extension. And the remaining group are in some sort of loss mitigation or deferral program. And if you look at how they're performing, about 3/4 of the people that have left and entered a loss mitigation program of some sort are still making their payments on time. And again, if you compare that to where we were coming out of the Great Recession, when just about everybody who was entering a forbearance program of some sort was defaulting, just a night and day example of how positive this has been. We have seen a little bit more activity of late among borrowers exiting forbearance. They're in active loss mitigation, which a lot of them had not been earlier. They're delinquent on their loans and not yet in a program, or we've seen some sort of foreclosure action. Now, the servicers I talked to tell me that a lot of the people in those foreclosure actions have returned to them and asked to be put into some sort of loss mitigation program. So we'll see how that all works out. So again, the remaining folks may need a little bit more help, but even with this, we are seeing the delinquency rates up marginally, but not in a meaningful way. Foreclosure starts are down. We're not seeing a lot of prepayment activity. We'll get into these numbers in a little bit more detail, but if you look at the national delinquency rates, this data from Black Knight in their last report, June, showed delinquency rates at 3.21%. Not quite the record lows of all time, but pretty darn close. And if you look at where we're seeing delinquency levels, the increase has been in the early stage delinquencies. So you're looking mostly at 30-day delinquency rates increasing a little bit. By the time they get more significant, 90 days plus delinquencies, they're actually trending down. So even with that slight uptick in overall delinquency rates, we are down below the long-term average, which is between 4% and 5%. And again, we're seeing a lot of activity on the part of the servicers to help those distressed borrowers. So when you look at the year-to-date numbers, whether you're looking, and that's the third column in the left-hand chart here, whether you're looking at delinquencies, foreclosures, foreclosure starts, seriously delinquent loans or loans in foreclosure, all of those are down on a year-over-year basis pretty significantly. The only of those categories that's showing a yearly change in the more recent numbers is foreclosure starts. But if you look at that historically, I'll show you in a second that we're still down at about 60% of pre-pandemic levels. And again, look at total delinquencies year to year. A year ago in July, we were at 3.3%. Today, we're at 3.2%. So nothing to write home about here in terms of the next wave of foreclosure activity. If you look at this data, and this is from Adam's August foreclosure report, so even more current data, you can see that if you look at things month over month, really not much in the way of significant changes. And we're running at about 60% of 2019 levels. Whether you're looking at initial stages of default, property scheduled for sale, or lender repossessions. The only month we really had a spike in lender repossessions was March. I suspect that was a lot of old loans that were foreclosed on once they exited the forbearance and plan and the mortgage, the forbearance moratorium the government put in place. But REO levels, REO activity, bank repossessions are running at 30% of where we were in 2019. And I should probably point out that 2019 was not a terribly big year in terms of activity for foreclosures, and so we're not likely to get back to 2019 levels until sometime in mid to late 2024, and the REOs, the bank repossessions, will probably lag behind even further. One of the reasons for that is that borrowers have just an enormous amount of equity, somewhere between 27 and $30 trillion in homeowner equity. And before you say, yeah, but what about the people in foreclosure? Well, it turns out that 92% of borrowers in foreclosure have positive equity, and 88% of borrowers in foreclosure have at least 20% equity. So we're not talking about just a little bit of equity here. We're talking about a ton of equity. And what's happening is that borrowers are selling these properties before the lender has a chance to foreclose and take the property back. So if you look at distressed property sales overall, take a look at properties in foreclosure, properties sold at the auction, or properties that have been repossessed by the banks and then sold as REOs. About 63% of property sales today, according to some data from auction.com, are selling prior to the auction sale. So borrowers are leveraging the equity they have in their properties to sell a property before that auction takes place and protecting that equity so they have something to restart their lives with. Very, very different than where we were prior to the pandemic, where the majority of sales were actually bank-owned homes, REOs. So if you're waiting for those bank repossessions, that's probably not the right strategy this time around. You really need to be moving upstream, working at the auctions and working directly with distressed borrowers. So just to kind of recap what we've already talked about today, from my perspective, just based on historical tendencies, a recession still seems likely, but probably not until next year, and probably a fairly short, fairly mild one. Unemployment rates probably not going up much above 5%, which shouldn't have a huge, huge impact on the housing market. We are looking at the highest mortgage rates in 23 years. That's likely to keep home sales depressed. Probably about 4 million existing home sales this year and about 675 in terms of new home sales. New home prices are falling a bit, but existing home prices look like they're recovering. And mortgage rates should decline once the Fed ends its current rate hike cycle. Again, keep in mind, according to Freddie Mac, every time the Fed has stopped a rate hike cycle, we've seen mortgage rates start to go down. Rental market's likely to grow because a lot of people can't afford to buy a house with a combination of today's high prices and high mortgage rates. And in that rental market, prices appear to be stable. Vacant rates remain low, even with that inventory coming online, probably because we're having millions and millions of people reach that adult age where they're ready to form households. And because of that demographically driven demand and the lack of supply, doesn't look like there's any home price crash on the horizon or a wave of foreclosures, even if we do have a recession. Just too little supply, too much demand, and too much equity out there. So with that, and with just a couple of minutes to spare, that's all I had in the way of prepared comments. I will stop sharing and turn this back over to the folks at Alpha. And if there were any questions that anybody had, or if anything that Jane, you'd like me to address, I have a couple of minutes to do that.
Thank you, Ray. It was very, very thorough and very meaningful and informational session with you. And then we went over, mortgage market to housing market, and also investor activities to delinquency and foreclosure activities. Very, very thorough. And thank you so much for your wonderful information. And I saw someone already raised their hands. Helen Cho, you still have a question? We might be able to address that. And Rick, do you have a little bit of time to take that?
Yeah. It might be easy if people entered that into do you have the chat area open?
Yeah, we do. And then I saw the Q&A. There is one open.
That was just a thank. That was just.
Oh, that was just a thank you. And then let me kind of allow Helen to talk. Yeah, we'll give a recording of whoever signed up and put in their email. So we'll send it out shortly. Hi, Helen, are you still there?
Excellent. Wonderful. I like it.
Thank you. You have any questions?
No, thank you.
Oh, you're welcome.
Okay,
You're
thank
welcome.
you so much. We appreciate it. And then for those of you who are curious about, our next event, it's going to be on November 1st in person in our San Jose office. We actually invited the state treasury. So her name is Fiona Ma. She is the current state treasury of California, very big person. And then she'll be giving out the latest policy about, ADU and also the funding on the Dream for All funding. So if you're interested, you can always, check out our Eventbrite website and sign up for that. So she's going to be giving out also very informational insights about affordable housing, ADU. And we heard that there are new policies coming out for ADUs that you can actually sell it individually. So these are all information that she's going to give out on our next event. It's going to be November 1st in person. And thank you again, Rick. If you have any last closing thoughts, if not, then we can actually call it for the session. And thank you
Nope,
everyone for joining. We really enjoyed this kind of event. Thank you, Rick, again.
Thank you.
Thank you.